Welcome to vTalkInsight Allocator's Lens Daily for December 31st, 2025. Cross-asset markets are closing the year with powerful AI and fiscal growth themes, but they sit on top of a divided Federal Reserve, stretched valuations, and some of the strongest moves in metals in decades. Today, we will connect those forces across equities, rates, credit, currencies, and commodities so you can see where this cycle looks late, where it still has momentum, and what that might mean for portfolio risk. In equities, the core story is that price action still looks like a powerful bull market, even as the fundamental narrative becomes more nuanced. Global indices have posted broad gains this year, and international markets from Europe to parts of Asia and Latin America have in many cases beaten U.S. benchmarks, with some country indices delivering returns that in dollar terms run from roughly 20 to well over 50%. That outperformance overseas, combined with the S&P 500 grinding higher on low volatility and a VIX index sitting in the low teens, underlines strong risk appetite, even as many allocators talk more openly about late-cycle risks and higher drawdown potential into 2026. Outside the United States, the leadership has been striking. European equities, including Germany and especially Spain, have delivered standout gains for dollar investors, helped by fiscal expansion and sector tilts toward beneficiaries of global growth and higher rates. Several developed and emerging market indices have returned 30 to even 70% in dollar terms, and there is a clear message that diversification away from concentrated U.S. indices has been rewarded this year. Japan has also been supported by reforms and stimulus, although rising tariffs and tensions with China are a watch point for that story next year. The engine behind much of the equity enthusiasm remains artificial intelligence and the associated capex boom. Major technology companies are expected to lift capital spending from around $350 billion to roughly $450 billion next year, with AI infrastructure at the core of that increase. Semiconductor leaders, such as NVIDIA and Broadcom, are still viewed as having room for earnings upgrades through 2026, and commentary suggests every dollar invested in leading-edge chips could generate many times that in broader ecosystem revenue. Large platforms like Microsoft and Amazon are highlighted for significant upside potential tied to cloud and enterprise AI, while Meta's recent acquisition of a Singapore AI firm and SoftBank's multi-billion investment into OpenAI underscore how aggressively balanced sheets are being deployed into this theme. Importantly, the rally is no longer only about a handful of U.S. megacap names. There has been a visible rotation into cyclical and real economy stocks, with industrials, communication services, and financials participating alongside technology across many regions. Banks are described as operating in an especially supportive environment, with solid credit quality, strong capital markets activity, and productivity gains from AI helping margins. In addition, expectations that central banks cut more than currently signaled create a narrative in which smaller companies and more domestically focused sectors could benefit, especially if borrowing costs finally move lower and global growth proves resilient. Yet the underlying risk picture in equities is far from simple. Institutional portfolios still show heavy overweights in technology, particularly in the largest firms, while many other sectors sit at neutral or underweight allocations, keeping concentration risk elevated even as leadership broadens. Active U.S. equity mutual funds have suffered more than a decade of net outflows, with another large step down this year as roughly $1 trillion left active strategies and hundreds of billions flowed into passive ETFs. That persistent move into index vehicles increases exposure to the same crowded benchmarks that are already highly concentrated in a handful of large-cap growth and AI names. The fundamental bar that companies need to clear is also rising. Earnings expectations for 2026 have been revised higher in an unusually aggressive way, with many companies projected to expand margins from already elevated levels. Recent trading patterns show that firms missing estimates are being punished more severely than those that beat, regardless of starting valuation, which signals an unforgiving backdrop if growth or profitability disappoints. Analysts argue that with valuations already rich, especially in the U.S., future equity returns are more likely to depend on genuine earnings delivery rather than further multiple expansion, leaving less room for error. Overlaying all of this is a macro and geopolitical environment that could inject more volatility into what has been a remarkably calm tape. The Federal Reserve is divided on the pace and timing of further cuts. Inflation is proving sticky around 3% rather than gliding to target, and large fiscal deficits raise questions about the long-run cost of capital. At the same time, conflicts in the Middle East, ongoing war in Ukraine, rising military activity around Taiwan, and a U.S. administration expected to lean heavily on executive action all point to elevated policy and geopolitical risk. Many market participants therefore see scope for 10 to 15% equity drawdowns as a normal feature of the coming year, even as structural themes like AI investment, global growth in 2026, and sizable tax-driven fiscal stimulus continue to support the medium-term earnings picture. With that equity backdrop, the next logical question is how the rates market is digesting the same mix of growth optimism and policy uncertainty. The rate story is defined by a central bank that is no longer marching in a straight line. Recent communications reveal a Federal Reserve that is split with multiple dissents and open disagreement about how quickly to ease policy given inflation that is still closer to 3% and a labor market that is cooled but not cracked. Some officials are signaling little appetite for cuts in the first half of the year, while others are more comfortable with an ongoing easing cycle that could eventually take policy rates toward a historically neutral level by 2026. Even where there is consensus that more cuts will likely be needed over time, the expected size and market impact are in question. The Fed has already reduced rates several times, and yet borrowing costs for mortgages and many loans have not fallen meaningfully because term premiums and concerns about government borrowing keep longer-dated yields elevated. Commentary suggests that, after an initial 75 basis points of easing, further reductions in the policy rate could come in smaller increments, and their ability to pull down market yields may be constrained by fiscal and inflation dynamics. Market pricing reflects this tension through a steadily steepening yield curve. Two-year Treasury yields are anchored below 3.5%, while 30-year yields sit close to the high fours, and long-end rates are expected to remain relatively high. Several voices argue that the 10-year is unlikely to fall much below the mid-3% area and could revisit levels near 5% by 2026 if fiscal deficits, sticky inflation, and supply chain reshoring keep term premiums elevated. That backdrop supports banks and some income strategies, but raises the hurdle rate for long-duration assets and for equity valuations tied to discounted future cash flows. At the same time, structural forces in the Treasury market are mitigating some of the more extreme tail risks. Issuance is increasingly concentrated in the front end of the curve, reducing duration risk, and recent reforms to cross-margining and collateral have expanded dealer capacity to intermediate flows. Private foreign ownership of U.S. Treasuries has remained resilient, with real money investors still viewing the asset class as the deepest and most reliable safe haven, even as fiscal worries mount and alternatives remain limited. There is awareness of concentrated leveraged hedge fund positions that could amplify volatility if unwound, but that risk is generally seen as contained for now. Looking ahead, the rate market offers two broad scenarios that matter for allocators. One is a more dovish outcome in which shifts in Fed leadership and a softer labor market lead to additional cuts, lower real policy rates, and a period of subdued rate volatility and easier financial conditions in early 2026, which would tend to support risk assets. The other is a stickier inflation path, where persistent 3% inflation, firm wage growth, and large fiscal deficits keep the Fed cautious and long-end yields high, restraining valuation multiples and leaving financing costs elevated. Inflation data, labor market momentum, and political developments around Fed leadership will be key inputs for which path dominates, and these same forces are already spilling over into credit conditions. Credit markets sit squarely at the intersection of the growth story and concerns about policy and leverage. On one hand, robust nominal GDP, powerful AI investment, and resilient corporate balance sheets are keeping defaults contained and spreads relatively tight. On the other, there is a clear shift in tone toward favoring higher quality issuers and being more selective further down the credit spectrum, reflecting uncertainty around the Fed path, inflation, and the durability of current profit margins. A focal point is the surge in investment-grade issuance from large technology firms funding AI infrastructure. This wave of supply supports capex plans, but also creates concentration risk in credit exposures and raises the possibility that spreads could drift wider if demand struggles to keep pace. That said, top-tier hyperscalers are described as having manageable leverage and strong coverage ratios, making their long-duration bonds appealing for investors prioritizing quality, provided they are comfortable with the sector and duration risk. Banks themselves are in a relatively constructive position for now. They benefit from a steepening curve, solid credit performance, and efficiency gains from digitization and AI, which together support profitability. The risk case is that a slowdown in the real economy or an unexpected rise in unemployment weakens loan demand and compresses net interest margins, especially if policy rates fall faster than long yields, squeezing spreads just as credit losses begin to pick up from low levels. Beyond public markets, private credit and private equity continue to gain share in multi-asset portfolios. Traditional bond allocations have delivered underwhelming returns over the past 5 years, increasing interest in private lending vehicles and middle-market private equity, where underlying companies are said to be growing revenues at a multiple of nominal GDP while trading at discounts to listed small caps. New vehicles are also opening private credit access to a broader investor base through structures like ETFs and retirement plans, but that comes with clear warnings that liquidity and product complexity remain important risks to monitor carefully. From here, relative returns in credit will increasingly hinge on how the Fed navigates its easing path and how that in turn shapes the dollar and cross-border capital flows. In currencies, the balance of evidence points to a gentle bearish tilt on the US dollar, but with important caveats. If the Fed ultimately cuts more aggressively and aligns with a global easing trend, that would tend to weaken the dollar and enhance local currency returns from non-U.S. assets for dollar-based investors. Institutional flow data show that strong dollar selling earlier in the year has faded to a more neutral posture, with little fresh buying implying limited support for a renewed surge in the greenback. At the same time, central banks are steadily increasing their gold holdings and trimming dollar reserves, reinforcing gradual de-dollarization themes. However, the policy narrative is not one way. U.S. economic leadership continues to emphasize a strong dollar stance, linking currency weakness to potential financial instability and renewed inflation. While inflation surprises in parts of Europe, such as recent upside data from Spain, could keep the European Central Bank cautious about cutting quickly. The result is an FX landscape where the structural pull toward a slightly weaker dollar coexists with official rhetoric and regional inflation dynamics that can generate bouts of countertrend strength and elevated volatility. Digital assets now sit firmly inside this macro FX conversation. Major cryptocurrencies like Bitcoin and Ether have been rallying into year-end, in part on expectations that Fed rate cuts in 2026 will boost risk appetite and liquidity, and in part due to growing confidence that regulatory clarity is coming. Industry leaders anticipate that new legislation and rulemaking will clarify oversight of non-Bitcoin tokens and market structure, potentially unlocking a new wave of institutional adoption, including for AI-linked tokens and tokenized equities and ETFs. At the same time, there are idiosyncratic risks, such as possible index reclassifications that could force passive selling of some digital asset treasury companies, underscoring that crypto remains a high beta, policy-sensitive segment of the risk spectrum. Commodities, and metals in particular, are where several macro themes converge most clearly. Gold, silver, and copper have all delivered exceptional performance this year, with precious metals on track for their strongest annual gain since the late 1970s and copper up more than 40% for its best year since before the last decade. These moves signal a combination of robust demand, persistent inflation concerns, and growing unease about currency debasement as central banks and investors anticipate easier monetary policy ahead. Gold's bull market has evolved from being driven primarily by Eastern central bank buying to increasingly reflecting Western institutional accumulation. For many allocators, gold is now framed less as a tactical hedge and more as a structural component of the portfolio, supported by ongoing macro uncertainty, questions about fiscal sustainability, and a desire to diversify away from the dollar. Silver has ridden the same wave, but with far more volatility, reflecting both safe haven interest and its role as an industrial metal tied to electronics and renewable energy. Recent thin liquidity and sharp price swings suggest that positioning and microstructure, not just fundamentals, are now key drivers of short-term moves. Digging deeper into silver, several technical and policy factors are amplifying its price action. Supply remains tight due to potential export restrictions and regulatory reviews around critical minerals, while a shift from pure physical shortages toward liquidity constraints has given retail flows an outsized influence on pricing. Exchanges have responded by raising margin requirements, and some funds are limiting new inflows, which can create air pockets in liquidity and contribute to outsized intraday moves when new information hits the tape. Copper's rally is rooted in both cyclical demand and structural change. Traders have accelerated shipments to U.S. ports ahead of potential tariffs, tightening global supply, while data center and energy transition investment have created a powerful medium-term demand story that has fed expectations of increased merger and acquisition activity in copper mining as larger players seek growth, and it has spilled over into renewed interest in platinum group metals like palladium and rhodium, where hybrid vehicle demand remains solid. The strength of these markets reinforces a view of firm global growth and ongoing inflation pressures, even as some developed market central banks talk about easing. Energy markets, by contrast, send a more mixed signal. Oil faces a structural oversupply that could reach several million barrels per day by 2026, which is likely to cap crude prices even in the face of significant geopolitical risk, helping to keep headline inflation from re-accelerating sharply. Where price pressure is building is in natural gas and electricity, where demand from power generation and data centers is pushing benchmark U.S. gas prices toward a projected $5 to $7 per MMBTU. Energy availability is increasingly described as the binding constraint on further AI infrastructure expansion, creating a feedback loop where the same data center boom that powers equity and copper stories also raises input costs and inflation risks. Those cross-currents bring us back to the overarching question of how allocators balance growth opportunities with late-cycle vulnerabilities across the asset mix. Pulling the threads together, the cross-asset picture at year-end is one of strong growth momentum and powerful AI and fiscal tailwinds, set against a backdrop of a divided Fed, elevated valuations, and some of the biggest commodity moves in decades. Equities are benefiting from broadening leadership and international outperformance, but the earnings bar is high in geopolitics and policy uncertainty argue for expecting more volatility. Rates markets are wrestling with how far and how fast the Fed can cut in the face of sticky 3% inflation and large deficits, keeping the curve steep and long-end yields a crucial input for all risk assets. Credit remains supported by solid fundamentals, yet increasingly tilts toward higher quality issuers, even as private credit and private equity absorb more of the search for diversification. In currencies, a gentle drift toward a weaker dollar coexists with strong dollar rhetoric and de-dollarization flows into gold, while crypto and tokenized markets are steadily institutionalizing as policy clarity approaches. Commodities complete the picture, with gold, silver, and copper signaling both growth and inflation risk, oil acting as a release valve, and rising power prices reminding markets that the AI build-out depends on real-world infrastructure. For allocators, The key watch points from here include the evolution of Fed leadership and inflation data, the sustainability of AI capex and data center demand, the behavior of the long end of the Treasury curve, and whether today's extraordinary metals rally proves to be an overshoot or a durable regime shift. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.